Hello and welcome to this video on market-orientated strategies to promote economic growth and development. So in this video we're going to look at a range of government policies that are designed to promote the market. They're designed to help the market achieve economic growth and development. So the government might have lots of policies it could potentially introduce. Here is a whole range of different policies a government might use to try and promote economic growth and development. We're going to focus on market-orientated, easy for me to say, market-orientated strategies. And these are essentially pro-business strategies. So they're designed to encourage growth and development by setting business free. It's argued that private sector growth, private individuals, private businesses is the best way to deliver development. Businesses spread prosperity and economic growth. This also reduces the risk of government failure. So before we start looking at these policies, there are some general criticisms of market-orientated policies. Sort of concern that free market-orientated policies will lead to income inequality, that promoting businesses might generate ethical issues, particularly about the treatment of workers and the treatment of local suppliers. There might be issues to do with transfer pricing and avoidance of tax, and over the sustainability of the production process, things like asset stripping. These are the 6 market-orientated strategies that we're now going to delve into in a little bit more detail. The first strategy a government might pursue is trade liberalisation. And this goes under the mantra that you might have heard of trade not aid is the best way to develop the economy. So trade liberalisation is when the government removes trade barriers, allowing the imports of consumer goods which may be of better quality and therefore increasing standards of living. Allowing the importation of capital goods may be particularly important for business investment. And some developed countries have barriers on cheaper goods from developing countries. And so also persuading those countries to liberalise trade through their participation in the WTO, for example, can help provide access to foreign markets for developing countries, which may allow them to exploit comparative advantage, economies of scale, and attract FDI. However, as we've seen previously, there is a risk that we become dependent on primary products or goods with low added value. There is also a counter-argument that having some protectionism allows infant industries to develop. The second thing the government might try and do is attract foreign direct investment. And we can see that actually FDI flows are quite significantly bigger than aid flows to countries. In fact, we see that capital flows to developing countries are quite significant. There's a net flow of FDI to developing countries rather than out of developing countries. On the left here, we have a chart of Africa showing the countries that are the top 5 most common destinations for FDI. So we have Nigeria, Egypt, South Africa, Mozambique, and Congo. We can see that over half the world's FDI now goes towards developing economies. Why do we want FDI? Or what might bring FDI to our country? The opportunity to earn supernormal profits, to access markets that have increasingly high income per capita. If we locate in particular countries, we can avoid trade barriers. We can also reduce our costs as a multinational company. So these are some of the drivers that are going on at the moment, which are encouraging multinational companies to undertake FDI into developing countries. What might a developing country government do to attract FDI? Well, these might be some of the ideas. So a quite common one is lowering the corporation tax rate. We could also maybe offer some sort of loans, trying to improve the quality of the labour market, creating special economic zones that have lower regulations or perhaps again lower tax rates, improving infrastructure, opening up capital markets. What are the benefits of FDI? Well, we might see a rise in investment, which leads therefore to a rise in GDP, and we often call this the infrastructure accelerator effect. So it becomes self-fulfilling, and as GDP rises, more investment occurs, and so on. We can see more capital intense work being performed, moving away from primary products towards more manufacturing products and tertiary products. We could generate a lot better technology, maybe creating new jobs as well. So here we have some of the positive effects, positive multiplier effects, better technology, increasing GDP, creating extra jobs, but we might also consider some evaluations. So again, the multiplier depends on the size and the extent of the multiplier. It depends on the product and the quality of jobs created. The increase in GDP growth may be resulting from natural resource depletion, which makes the growth unsustainable. And a TNC or multinational company may bring their own skilled workers into the economy, rather than creating domestic opportunities. What are some of the negatives of FDI? Well, often FDI we accuse of leading to inequality. The profits from the multinational transnational company flow disproportionately to the powerful elites. We often see a lot of land grabbing going on, particularly in Africa, foreign countries buying up land to grow crops and repatriate them back to their own country. It doesn't really generate any extra economic growth for the country. Often TNCs will base themselves in countries because there are poor ethical standards. So this won't necessarily improve. In fact, it will be encouraged. There's nothing guaranteeing that foreign direct investment will stay in one particular country. So we often describe it as being footloose, and that people can easily move production to another country quite quickly. Okay, another market-orientated strategy is a microfinance. And microfinance basically breaks down into a number of little areas. So we could talk about microcredit, so providing small-scale loans to the poor, micro savings, providing the opportunity for some income to be saved for people in developing countries, micro insurance for people who run businesses, and the ability to transmit money or move money back home, back to a developing country. Typically it involves the use of technology and in particular mobile phones. Here's an example of a company involved in microcredit, making small loans, very small loans to people in developing countries to help them invest. Some stats on the right hand side there. This foundation is working with 22 non-governmental organisations. It's helped over 220,000 women take out loans, and over 95% of loans have been repaid. So what are the aims of microfinance? Well, it's aiming to try and include people who've had no access to the financial system in some sort of financial service. So we can raise domestic savings. As we know from the Harrod-Domar model, this can then lead to further investment and economic growth. Through insurance, it might promote people to be more entrepreneurial, and therefore, again, this promotes economic growth and development. Also enabling women in particular to take an active part in the economy. However, there are some criticisms of microfinance. Some criticism is that we have seen what is known as subprime style lending, so lending that's not really appropriate to people, enabling, so they may have a low chance of being able to pay it back. Sometimes we see lending with high rates of interest. Really what the issue is not the ability to save, it's actually the level of incomes. So perhaps allowing them to save doesn't really address the problem. What we need to see is incomes to rise. A lot of work has been done that actually says rather than allowing loans, just a direct cash transfer to poorer households would have a better long-run effect than the ability to take out a loan. And lastly, credit, if it's used to finance consumption and not investment, actually can make matters worse. We have indebted people rather than people who have no debts. So mention here briefly a micro insurance. So microinsurance is providing an insurance scheme, so I pay a little bit often on a policy, but if something goes wrong with my business, then the insurance company will pay for any claims that I might have. So this encourages some risk-taking, which can be a good thing because it helps promote entrepreneurship and economic activity. Insurance can also help smooth volatility in income and lending. We said earlier that a lot of developing countries suffer from volatile commodity prices. Well, if you have an insurance scheme, then actually if prices are particularly low one year, then the insurance company will pay out to cover any losses that you might make. More children from poorer families will be able to continue their education. You can get insurance cover for burials and things like this. And life insurance schemes promote small-scale saving as well. So there are lots of positives to microinsurance. Again, however, there are also some criticisms. There's a criticism here that this leads to moral hazard, that actually once you're insured, you're more reckless and you take greater risks because you are protected. Often we have adverse selection. The people trying to take out policies are particularly the ones who are likely to make a claim, so the system won't work. And like with all insurance schemes, we have this issue of asymmetric information. Okay, the fourth market-oriented strategy is the removal of government subsidies. This creates an incentive for domestic producers in a developing country to become more efficient. This can make them more competitive globally. It also can address the issue of opportunity cost, in which it's hard to justify perhaps for some developing country governments while they're funding industry rather than investing in welfare and infrastructure projects. This avoids cronyism, which can be particularly a problem in developing countries in which politicians support industries in which they have vested interests. It's also consistent with the theory of comparative advantage and can be used as a bargaining tool at WTO talks to remove developed country subsidies and developed country trade barriers. However, we may argue that the removal of subsidies may destroy infant industries or industries of key strategic importance, and these may be difficult decisions to implement politically. The fifth approach is privatization. Supporters of privatization believe that the private sector and the discipline of free market forces are a better incentive for businesses to be run efficiently and thereby achieve improvements in economic welfare. It's also seen as a way of reducing trade union power, widening share ownership to the population, and may also lead to increased investment. It's considered an important supply-side policy by many economists designed to drive competition and improve productive and dynamic efficiency. Indeed, when we look at the cost of water around the world, we see that privatized companies that are regulated in developed countries are here potentially much more efficient than the inefficient public sector state-owned national water industry companies from developing countries. However, as with everything, there is a risk here that privatization may lead to asset stripping. Just because it's owned by private individuals doesn't mean that there will necessarily be an improved performance. This might be particularly relevant to developing countries where there already exist high levels of corruption and ineffective management skills in many cases. Our final policy is to make our exchange rate free floating. That's where the value is determined by demand and supply. And this can serve as a natural stabilizer to fluctuations in commodity prices. So when commodity prices are high, people are buying more of our currency in order to buy our exports. So our currency value increases, reducing the attractiveness of those exports. So we don't get so many big surpluses. But also when current commodity prices are low, the currency value will decrease, increasing the attractiveness of exports so we don't get as big deficits. In addition, maintaining a fixed rate or a managed rate can use up central bank resources. However, developing countries can often see large exchange rate volatility when they move to a floating free market exchange rate. They can also be victims of speculation, and this can disrupt trade and cause swings in the price level domestically, hindering economic activity. In the map here in the top left, countries with dark green, the countries that are dark green have floating exchange rates. Light green means a managed exchange rate, and the blue countries here have fixed exchange rates. So we can see again, looking at Africa and Asia, a predominance of managed and fixed exchange rates. So in this video, we've looked at a range of market-orientated policies a government might consider in order to try and promote growth and development. That's it. Thanks very much for listening.